So, right, now how to use the MACD, and this has been a very heavily requested session, hasn't it, Jonathan? For the last few weeks, I guess a lot of people have got an interest in the MACD, and it's been a well sort of requested subject, should I say. Now, before we do start, and Jonathan will kick things off, as per usual, there's a short disclaimer which I'd like to just go through. So spread bets and CFDs are complex instruments and come with a risk of losing money rapidly due to leverage. So 75.2% of retail investor accounts lose funds when trading with spread bets and CFDs. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your funds. So past performance of any strategy or trader should not be relied upon for future performance. Okay, now 2A markets, as most of you already know, we've been operating since 2003. We are fully registered and authorised by the FCA here in London, and we work under the name of TMS Capital. Now today, as mentioned, we're going to be looking at, sorry Jonathan, I think I've just messed up your slides there.
Yeah, don't worry, spoilers.
Yeah, no, spoiler alert, exactly. I'm never to one to spoil things, but so what we'll do is we'll kick off with a little refresher of what MACD is and where it actually starts all from. So Jonathan, you take it away.
Yeah, absolutely. So yes, last week we actually we covered a topic, moving averages, and so there's going to be a few people, of course, in today's session that didn't attend the previous session, and so I just want to give a brief recap of moving averages, and the reason being is that they do form a pivotal component of the MACD indicator. So before I introduce a new topic, I need to just look through the previous topic just very, very quickly here. So moving averages, again, was a topic which we covered last week, and you can see the recording on the 2A Markets website if you would like to have a look at that again. But basically, what we have here is this pink line currently showing on this chart. Now, this pink line is simply just an average of the price information that comes before it. So what you'll find is that it really smooths out, filters out all the noise of the market, really, because there's often quite a lot of volatility in the market which create false signals when trading, and moving averages basically look to eliminate that. So if you bear with me, I was hoping just to bring up, if it loads here, that is. Yes, here we are. So when you're typically trading on a chart, you might find that the price is going up, down, up, down, all zigzaggy. It's not really going anywhere. But of course, a moving average, where it's just an average of the prices which are occurring on the chart, you would find that in that instance, the moving average would be pretty much flat. And so you know that the market isn't really going anywhere, it's eliminating all these like false signals, really. It's just pretty much flat. Whereas if, let's say, I was just to remove that, let's say actually, in fact, the market price has been trending up. Of course, you're always going to find your peaks and troughs as it goes up and down. However, the moving average will just smooth that out, so you can see that generally speaking, that the market is going up. So it's just an average of the previous prices. Now, if I was just to head on over back to the slides here, so bear with. It's important to mention here that you can have moving averages looking at different periods. So you could have a average which is calculated over the last 5 candles, which basically means that you add up the price of the previous 5 candles and then divide by 5, and that would give you that average price. Or you could have over much longer periods of time. And if you were to look over, let's say, 20 candles as opposed to 5 candles, then it's going to be less sensitive to those spikes in movement. And so that's a key point to make here. because last week we actually showed that you can have multiple moving averages on a chart. In fact, at the moment, you'll notice on this screen here that I have a red moving average as well as a blue moving average. Ultimately, these can be any color we want, but the red moving average here is something what we would call a fast moving average, in that it has a smaller, it's looking over a smaller number of candles. It might be, for example, it's looking over 10, whereas that blue moving average is looking over a longer period, and so it reacts slower to the actual price movement. It might be that's something like 15, for instance. So the red moving average, the fast moving average, is going to respond to the market moves that much quicker as a result. And last week in our webinar, we were highlighting that quite often you find crossover points where the moving averages, the fast moving average, so the quick trend actually pulls above that of the longer term moving average, and so that would identify potential trading opportunity. And just like if the fast moving average crosses below that of the slow moving average, that would identify a selling opportunity. Okay. Now, I just wanted to cover that because, of course, again, it does play a pivotal part of the MACD, which we'll be looking at shortly. But we did highlight two different types of moving averages. There are, in fact, lots of different types, but there's two main types, that being a simple moving average, where essentially each candle has equal weighting. So if you were looking over the last 5 candles, each of those 5 candles are added up and then divided by 5, and that would give you your moving average price. Whereas exponential moving averages, which again was something which we introduced, it actually gives greater weighting to more recent prices. So it's going to hug the price more closely on the chart, and they're known as EMAs. Okay, so it's worth just being aware of the two. I'm not going to go through the calculation of exponential moving averages. It's quite difficult, but fortunately, this is all something which is done on our charts automatically anyway. So we're not needing to get a calculator out when we're looking to use EMAs or the MACD indicator. Okay, so with all that said and done, hopefully everyone's clear with moving averages. Just as a slight recap, what I'm going to do now is actually discuss MACD. I think it might, however, just be valuable if I was just to launch a poll just very quickly here, though. Just want to see a raise of hands as to how many people have used MACD before, as we always like to get just a gauge of how individuals find that. So I've just launched that. That should be on your screen. Hopefully we can just get a few votes here. And Gerp, I don't know whether you're seeing these results, but it's quite close at the moment. 51% of people have said yes, and that means 49% of people say no, and about 70% of people have voted at the moment. So it is very, very close here.
I would have actually thought more people would have at least tried it, actually, so I'm pretty surprised at that.
Yeah, see, MACD, it is one of the most popular indicators, and I'll be going through why, but it's very simple and flexible. You can actually gain a lot of valuable insight when using the MACD indicator. So moving averages, which is again a topic which we covered last week, that plays a big key component of this indicator. But these two indicators, they're the moving averages and the MACD, I would say that they're the foundations, the ones which traders, when they're first learning, that they would typically find because of where they are most popular, and you'll find them on any broker platform really anyway. Now, it looks as if everyone's almost voted here, so just so everyone knows, 53% of people have said yes in the end, and 47% have said no. So thank you everyone for answering that poll there. Of course, today's session, though, it isn't just for those that said no, it is for those that had said yes as well, as we want to make sure that you're comfortable with how you'd use that and get the most out of that. And I'm just going through the questions here just before I actually answer that. Oh, there's a funny message from Richard here. Same as Brexit results. Dennis has actually mentioned here, can MACD be used effectively on indices? Yes, so I will be showing this actually on live charts. In fact, Gurpal, I know that you were wanting to show if you're on indices, currencies, I believe, and you can even use it on stocks. So lots of different types of markets can be used here. Okay, perfect. So MACD, it stands for the moving average convergence divergence, and it is a trend following momentum indicator. So you can use it either to find out what the trend of the market is, or to find the momentum of a market. And essentially it shows the relationship between two moving averages. And I'm going to, of course, go through that in just a second with you. And it can be interpreted in several different ways. And that's the key component of this webinar, to help you kind of learn how to use that to get the most out of that. It has been around for quite some time now. So it was 1979, certainly in the late 70s, that it was first created. And that was by Gerald Appel. Okay. Now, what does it look like? So essentially, there's three components which make up the MACD indicator as you would typically find it on a broker platform. And I'm going to go through each of those components step by step. So the very first component is what's referred to as the MACD line itself. And I'm just brought up a chart here. On the chart, the price chart, I have two moving averages. So the fast moving average, which is the red, as well as the blue moving average, which is a slower moving average here. Now, below the actual main chart area itself, we have the MACD. So it's below the chart area where you'll find this indicator. And the way this line is calculated is that it is taking the value of the fast moving average. So that's the red EMA on this chart here. And you're subtracting the value of the slow moving average from it. And so if I just get out my handy little annotation tools, hopefully you'll be able to find that I'm given some readings for my moving averages here on this chart. So I'm given some readings for this candle up here in the top left. So I can see that the value of the fast moving average, so in this example is a 12 moving average, was 28636.93. And as for the slow moving average, I was given a value of 287.68. Okay, and the MACD again is simply just shows you the difference between those values, and it's given me a value down here of 349.24, which is the difference between, again, the fast and the slow moving average. Now, if I just remove those terrible drawings there, bear with me. So what that means is that the more that these moving averages kind of diverge from one another, the higher this MACD line is going to show on our chart. Whereas if those moving averages get very close together, they start to converge, then that's when it's actually going to get to this like zero line shown on the charts here. The MACD line, of course, becomes negative when the fast moving average falls below that of the slow moving average. And again, the wider that is, the bigger kind of the drop here. So if we were just to have a look, again, where there's a wider divergence between the moving averages, that's where we're going to find kind of the peaks of the, well, and the trough of the MACD line itself. It's just looking at the difference between those EMAs on the chart. Okay, perfect. So that's the first component, the MACD line itself. If I just move on to the next slide here, what you'll find is I've added an additional line to this MACD section of the screen. And this is known as the signal line, which is an EMA of the MACD line itself. So again, it's exponential moving average of the MACD line. So therefore, it is always going to be delayed because it's looking at the average. It's basically a smoothed line of the MACD, and so it trails behind that. And there we go. So it's just a moving average of that blue line that we've already got on the screen here. Okay. Now I will go into this in a bit more information in just a second, but some traders would look actually at these crossover points. So when one line crosses the other as a potential to actually either enter the market or exit the market. But for example, if the actual moving average line was to cross that of the signal line, which we have here on the chart, then some traders would look to use that as a buying opportunity. But we'll go into that in just a bit more. I just want to give an overview of what that looks like on a chart to begin with. So that's the second component. The third component is the histogram. Now, I have to say, personally, I'm not a big fan of this third component. It's some brokers, you have to have that visible. Others, you can actually toggle that whether it's there or not. It's just displaying the MACD line minus the actual signal line. So basically, when there's like a crossover of the MACD line and the signal line, you'll find that the histogram will go to basically 0. And where they start to diverge the MACD line and the signal line, that would actually get wider histogram. And basically, it's there for individuals to identify the crossovers easier. Now, I say that ironically, I find it a bit more difficult, in fact, but it does depend on how the actual broker visually shows the histogram on a chart. So as just a bit of a comparison here, what I have is an alternative broker who shows the actual histogram slightly differently. And what you'll find is when there's this green histogram, it gets to 0. It's quite bullish here. It gets bearish. When it does this crossover, that actually is the same point that, of course, the actual MACD line has crossed below that of the actual signal line, hence why it's changed color there. So you can easily, by looking at the histogram and how it's changed color, you can easily identify crossover points. Okay. And as I mentioned earlier, the larger the histogram, the wider the divergence between the MACD and the signal line. Just like how where we were looking at things previously. If I take us back a few steps here. Too far, sorry. So just like how the MACD line itself is actually showing you the divergence between the fast EMA and the slow EMA. So the wider the difference between those, the higher these peaks and troughs. Just like that, the histogram, again, the wider the difference between the MACD and the EMA of the MACD line, the signal line, the larger that would then show as. But again, it's that some individuals would disagree, but in my opinion, the actual histogram part of the indicator, it's not necessary. Again, some individuals may find it easier to identify the crossover points, but that is just one way in which you can use the actual MACD indicator. And so you're probably now asking, well, how do we use it? I've shown obviously the components, those three components, the MACD line, the signal line, and the histogram, and I've discussed how those are calculated. Fortunately, again, you're not having to do the calculation yourself. This is something which is automatically plotted onto your charts for you. But the moving average convergence divergence indicator can be interpreted in several ways. So as I mentioned, some individuals use the crossovers of the MACD line and the signal line to identify trading opportunities. And also, and this is something which Gerpel will go through in a bit more information, something known as divergences between the actual prices which are shown on a chart and that of what the MACD is actually showing us as well. So just highlighting a few of those crossovers for a second. Again, either we're looking at the histogram and we see that it's changed color, it's gone like crossed over the zero. That's where there's been a potential to actually enter the trade. Same again here, of course, there is a change in the histogram from bullish to bearish, and so that would be an opportunity. Or whether we're just ignoring the histogram itself and looking just purely on the lines of the chart, the MACD and the signal line. If we identify a crossover, that would normally constitute as a trading opportunity. But again, what we're wanting to do is actually apply this onto some live charts to actually show you how this appears on those charts and a variety of different markets. So Gurpal, perhaps if I was just to load up one of these platforms, let's see what we have open first here.
Sure.
So yeah, Gurpal, can you show us a few examples?
Sure. Just before we do, I know Michael was saying the sound was very, very low. Just make sure you can hear us. Is the sound still okay, guys? Just want to make sure that you can hear us loud and clearly. I know Michael was saying the sound has gone very, very low and slow. I don't know. Hopefully it's still okay. Okay, it sounds okay. Fine. No, it's okay. Brilliant. Right, now let's get into the crux of it in terms of what MACD is and how you can use it. Now, the one thing I would say, Jonathan, is I think MACD is one of these indicators that really gets used incorrectly more than any other indicator. Actually, there's 2 or 3 ways that you can actually use this, and visually it's possibly the most aesthetically looking. It's one that think, wow, that looks quite nice the way it looks. But let me show you a couple of ways that's how I could apply it to live charts. Now, at the minute, you can use the MACD for the normal crossover like Jonathan insinuated. So this is just the German DAX. Now this is a weekly chart. Now each bar represents a week. Now very much like Jonathan was, yeah.
Yeah, sorry, just so everyone knows, this chart, there's a few annotations already on that chart. So those black lines, those are things which Gurpal added in previously.
No problem. So if you look at this vertical line, you've got the crossover round about here. Now, of course, that could be, it's a switchover point from when the MACD goes from a bearish to a bullish stance. And of course, that in itself could be a buying opportunity. So you obviously got these crossover points where the MACD crosses over. So you've got one here, you've got one there and there. Now, the other way I like to look at MACDs is a bit like RSI. Now, for those of you who came to our RSI session, you know what the relative strength index is all about. It's all about overbought and oversold. Now, you can use the MACD to identify overbought and oversold conditions. Now, the difference here is, unlike with the RSI, you have a gauge on the right hand side. So you've got the 20 and the 70 levels whether it's oversold or overbought. Now with the MACD, it's done slightly different. You have to actually implement these lines here. So you've got these, let me see if I can move it. Yeah, so obviously what I've done here is just put 2 horizontal lines. So all I've done here is just look to a level, an area. So this is a weekly chart going back to 2015. So we know that this area around here is when the market really has been overbought. So we've been, obviously we've got 2015 when the market was extremely overbought, 2017, we've got there close, and the same goes with the oversold section here. So we can see here how many times you could actually almost argue, say that's an oversold position on something like the DAX. So we've got an area here where the market twice has been oversold back here, and it's come again, and of course we had the COVID dip here when it was extremely oversold. Now we can use this in this method, so to suggest where the actual market has been moving, whether it's been oversold or overbought. Where I personally think the MACD comes into its own, and where I think it possibly works best is sorry, go on.
Yeah, I know what you're just about to say there, though. I think just looking at these tram lines which you've entered, I think it's just worth pointing out here that the reason an individual might want to actually put in these lines themselves is because MACD quite often there are lots of false signals with them. So you'll notice that there have been lots of crossovers, in fact, in between these points, but they don't really necessarily go anywhere. By putting in these tram lines yourself to identify the extreme values, that is where typically the MACD is then more effective. That's not to say that you have to put in those tram lines. It's just, again, by taking those extreme values, perhaps you can then go for stronger actual crossover points. But that's just my my little addition there. Sorry there, Gurpal.
Yeah, no, it's a valid point. I mean, this is the thing, like with a lot of indicators, it can give you false entry points. What this will give you is an area. So for example here, we know, for example here, just say 2019, we know this is a weekly chart, but the market's oversold. So we've got a cross back over here. So when the market did cross back over, there's a fantastic buying opportunity. And if we go even closer, back in March, now look at this. Look how the market. This is during the when COVID broke out. Well, of course, you know, we've got people trying to pick the bottom, but why try to pick the bottom? You've got the MACD telling us, actually, look, we've got the crossover here, and that's when the market started to rally. So you're probably buying here at 11,688. We're now currently standing at 13,200. So there you go. So, you know, again, it gives you those entry levels to show you where the market has been overbought or oversold. So it gives you more sort of promising sort of entry points. If I move on to something a bit more closer here, so if I bear with me. Now, what this here is the Euro US dollar on the daily. Now, what I'd like to highlight here is possibly the way I like to use MACD, and I think the most powerful way an individual can use MACD is through divergence. So whether that's bullish divergence or bearish divergence. Now, let me bring your attention to the chart here on the Euro US dollar. I've got a few charts here to show you. Hopefully we'll sort of give you an understanding of what divergence is and how it can help you. Look, now we've got the Euro US dollar. We've been trending down for a good few weeks and maybe a month. So we've got March, April, May. We've been printing lower lows. It's been coming down. But look at the MACD. The MACD, in fact, has been making higher highs. The MACD has not been following the same trajectory as the actual price there. Now, what that means is, actually, the market, although is coming down, it's running out of steam. It means that there is a close turning point here. Now, this is what we call a bullish divergence, where the MACD, in fact, is actually building itself ahead of steam, going upwards, but the pricing is going down. So what we can do here, potentially here, Jonathan, look, when we've got two or three times where we've had false crossovers. Now, we've got this crossover here. Now, if I just put in a line here now to show you the point of entry, you've got a much more there. Let's just say, where's the market? We cross over roughly around about there, and that's where you'd probably buy this market. So there. So if we're buying the market here, well, the rest is history. Look at the euro dollar after that. It explodes up. And this is just giving you one example of divergence, bullish divergence. It's absolutely. So Michael, the cross point would be that area where the histogram goes from red to green or negative to positive. But what I want you to understand is divergence here. The prices have been going down. The MACD has been climbing. Yeah. Let me show you that on another chart. So we've got exactly the same, except this is on the Euro US dollar. And this is a 15-minute chart. Now, you know, that was a daily chart, I believe. Now, you can actually use this on a 15-minute chart, and it's exactly the same. Have a look at this. Now, we've got the price coming down of the price of the sterling dollar. So we've been making lower lows here, higher lows here. So the market's been coming down, but look at the MACD. The MACD's come down and it's been going higher and higher. Now at the crossover point, which is here, I'll show you again. Let me go in and add the crossover point. So let's just say, let's make that bit bigger. So we've got a crossover point here. So you could actually go ahead and buy approximately the sterling dollar here. It's a 15-minute chart there. Look, there's the bullish divergence. Same again, price going down, but MACD and the signal line is actually showing bullish divergence. If you bought there on that crossover, bang, the market rallies. It's almost like a front runner. It's almost like a leading indicator. That's why I like to use the MACD like this. So this ain't lagging. It's giving you a bit of a heads up when the market is potentially turning. Let's move over to the Dow. Same again.
I think it was very interesting you just mentioned about the... sorry, Gerpel. I just thought it was very interesting how you mentioned about it. It's not really a lagging indicator. Of course, the actual moving average, the MACD line and the signal line, those parts are actual lagging, but it does certainly have elements of like a non-lagging indicator, a leading indicator. Yeah. So it's quite nice in that respect. That's why it is such a dynamic kind of indicator to use.
Absolutely. Someone's asked me, how do you know when to get in, what crossover point? But we'll just have a look at what I said earlier about being overbought and oversold. Look at this now. That effectively round here is an oversold area. You know the MACD's turned over once, twice, 3, 4, 5 times there. Now look at this one here. Look, we've got the price of the Dow and the hourly chart coming down. Quite obviously, you can see that coming down. Yeah, in the hourly chart. But look at the MACD. It's been coming over, and it's actually been printing higher levels in the MACD. So it's come back, it's gone back up again. So here, so really, I mean, there's no real precise point where the entry point is, but you'd want to give yourself the best chance of entry. So you'd really want to wait for the MACD to cross over closer to the zero line as possible. So if the MACD crosses here, you're too early, way below. You want to get closer to the zero line as possible. So if we again bring in the vertical line here, so yeah, we've got a crossover here, probably too early, again too early. But look, we've potentially got a crossover around here. So that's closer to the zero line. If I maybe push it here and then maybe put the price in there, look. Let me zoom into that again. Look, you know the MACD's been making its way up. Yeah, you know there's bullish divergence again. The market's going down, MACD's going up. I'm looking to buy on the next time this crosses over. I'm going to buy the Dow on the hourly chart. You buy the Dow here. Look at the rest. It goes from, so for example, we've even bought here 26,400. Well, I'm not going to say you're going to go all the way back up there, but you'll have got yourself some really nice pips there on the Dow Jones. It just goes to show just how strong. I wouldn't go any less than 15 minutes. Someone just asked me, Joanna, I would probably say, of course, with a lot of these sort of indicators, the longer term time frame will subjectively give you more accurate results. The shorter the time frame, simply this is far too much noise. And it's the same with the ADX, the same with RSI, the same with stochastics, the same with moving averages, and exactly the same with MACD. The moment you start putting in these indicators with like 2-minute charts, 5-minute charts, there's just too much noise, there's too much volatility. So this is an hourly chart just to show you here. So it's, again, a fantastic entry point here on the Dow. Now, let's move over to gold. Now, this is a daily chart on gold. Now, this is something slightly different, but look, this is something maybe that's brewing on gold. Look what I've done here. I've done these 2 tram lines here again. Now we know this is an area potentially that the gold has been overbought. I mean, we're seeing this massive rally this year, Jonathan, where gold has gone all the way from, you know, this almost $14 all the way up to $20 on gold, and we've been massively overbought here. Now, of course, since then we've been coming down. You can see the market's been coming down, and you can see the prices have been printing lower lows on the gold. But look recently. Now, although the MACD's turned over, it's gone negative, the MACD now is showing a bit of bullish divergence here. You notice that? Now, the prices are coming down, but the MACD is potentially looking to turn up. Now, the interesting point here is potentially there could be a buying opportunity on gold. So the next time this crosses back over, if we go through the theory, what I've just been showing you with bullish divergence, and it works with negative divergence as well, so bearish divergence or whatever you want to call it, it works exactly the same way. But if we use the same theory, that on the next turnover on gold, we potentially could see gold break up higher again. So that's just something to bear in mind. Now, I'm trying to go through charts, but give you some... Sorry, yeah.
Just very quickly, Chris just asked a question regarding the gold. So which gold stock is that? What's the ticker? This is actually just the spot gold price.
Spot gold. This is spot gold, yeah. This is spot gold, yeah. So let me just quickly show you the FTSE 100. So here's, again, hourly. It's a lovely example of the FTSE 100. Now, this could be a bit of bearish divergence. Now, let me show you this, Jonathan. Now, the FTSE, the last few days, as we know, it's been going higher and higher and higher. You can see that, look. Higher high, higher high. It's been going up and up. But look at the MACD. Look at the bearish divergence here. Even if I move this here, look, you can see the bearish divergence. We're making lower lows. What does that mean? It means potentially the FTSE could be running out of gas here. There's potentially a turning point on the FTSE. Now, I know today, look, we've rallied up. We've had one more spurt up here. Yeah, we've printed a high here, a recent high. Now, is this giving us a fantastic opportunity to sell? Now, what I would be looking at here is on the next opportunity, when this does cross down, if the MACD line crosses below the signal line, is that my entry point to sell the FTSE? Now, the divergence here is suggesting yes, it would be, because it's giving me negative divergence. The market's making new highs, but the MACD is not making new highs. That's negative divergence. Yeah, it's giving me an opportunity to now wait for this to turn back down, and when it does, to go in and pull the trigger. Yeah, so that's an opposite way of looking at things when we're looking at rather than buying into weakness, we're selling into strength. Now, someone was asking me about stocks. Yeah, but here's HSBC, exactly the same thing. So here's a weekly chart of HSBC. Now, we know how a lot of these stocks have been coming down. Now, look at this, HSBC. Since March, we've literally collapsed from £6.40. We've been coming down and down and down. Look, there we go. MACD's crossed over. We've been coming down. But look, Jonathan, look, the MACD is showing bullish divergence again. Now, the price of HSBC has gone all the way down to almost £2.75 there. Look, £2.80. But look at the MACD. It's actually been moving up. Now, this was the point of crossover. Now, say, for example, we even bought there. The MACD is crossed over there. That's the first point of crossover. You would have bought HSBC just over £3. Where are we today on HSBC, Jonathan?
It's close to £4. So that's an incredible trade, that.
It's an incredible trade. Again, bullish divergence. It's giving you almost a leading indicator to going when potential these moves might come in. So, you know, if you're going to use the MACD, I would suggest use it for an overbought and oversold scenario, but more importantly, look at the divergence. Look at it. I mean, the prices are going down. If the prices are going down and the MACD is doing the opposite, it should be telling you there's potentially something brewing ahead. There's potentially on the next crossover could be your entry point. Yeah. Hopefully, does that make sense? Yeah, I mean,
I think we're
to be honest with you,
that's good.
Yeah, Michael, what if the MACD and the RSI are not heading in the same direction? The problem is, Michael, the moment you start throwing in 5 or 6 different indicators, they're all going to be contradicting each other. If I'm being completely honest with you, I would bin 1 or 2 of them. You don't need so many indicators on your chart. Stick with one that you feel comfortable with. Now, the RSI does have its plus points, but also, as we mentioned a few weeks ago when we covered it, it can get you into the market too early. It can have its negative points. What I like about this, yeah, MACD can be used with ADX, because the ADX is simply showing you the trend change. So if I go to the ADX here, you can have a look here. Look, ADX has crossed over. There's a crossover on the ADX. See, so the positive has crossed over the negative. So the ADX is confirming what the MACD has been telling us, but the MACD has actually got us into the trade a bit quicker. Do you notice that? Yeah.
Yeah, I think it's always good to have. Oh, sorry.
Yeah. Yeah.
I was going to say,
Yeah,
I think it's always good just to have indicators which tell you different things. And it's always nice then to also get a confirmation like we have done with the ADX in this instance.
Yeah. So ultimately, there's going to be some indicators, like I've mentioned, it's going to be contradicting one another. And the way it's the same old saying, analysis by paralysis, whatever. If you've got so much on there, you just don't need it. What you need is, you need support and resistance lines on your chart, so you know recent highs, you know recent lows. That's, for me, the number one thing you should have on your chart, support and resistance. Everything else is a secondary for me personally. Someone just asked me what I like to look on my charts, and I'm telling you, support and resistance is number one. And after that, I might look at things like a moving average or a MACD, and maybe I could look at an RSI just to see if it has been overbought or oversold, an ADX. So I wouldn't have all of them at once. I'd basically, for me personally, a MACD works just as well as an RSI. It actually gives you everything you need. So potentially it does more than that. It gives you turning points. So I've just proved here today, just on a stock, you can see how you can use MACD as an overbought and oversold situation, and you can actually also use MACD in the bullish divergence, and of course, as I mentioned, in the bearish divergence as well.
And that again is why MACD is one of the more popular indicators, because it can be used to do several things, whereas lots of indicators are used primarily just for the one aspect.
Look at this,
so, just like you've shown.
This is a prime example. Look, the FTSE here. Look, guys, the FTSE is just, this is a high here. When's the last time we got to FTSE at this level? I mean, yeah, there you go. We haven't been at this level for ages. Look, the FTSE today at 64,460 is high, but look at the MACD. It's way down here. The MACD a few weeks ago was up there. So what that's telling me is the divergence. The FTSE is running out of steam. It's running out of gas. It's been going up since November, the end of October. The MACD is telling me it's running out of steam. Maybe it's time for a bit of a pullback. Yeah.
Well, Gerbil, if I just take control of the mouse here just for a second, we can actually find how it did go back to zero again. If you see the histogram, it basically was just crossing over into the bearish territory. Yeah. But again, of course, today has been quite positive. This might be the news which drives the market to continue on its current trajectory.
Wait for the confirmation.
Exactly. And Gerbil, we have had a question here. Just want to go through through a few MACD settings. What are the typical settings? So the default settings for MACD are 12, 26, and 9. Now, what does that mean? So it's looking at the MACD line is calculated by looking at the difference between the 12 EMA and the 26 EMA, and then the signal line is an EMA of the that MACD line, which is calculated over 9 periods, 9 bars. Now, if I go on to the MACD, which we have shown here at the moment, we can give that a click. Gerbil, the mouse is just flying around there, sorry. I've given that a click. It comes up with this panel on the right-hand side here, and I can change those periods. Now, Gerbil, I have to admit, personally, I've always ever stick with the default settings. These are the preferred settings by the individual that made the indicator. I haven't played around with too much with that.
I guess it depends on time frame. So if you're sort of looking to look at a lot shorter time frames, maybe you might want to have a tinker with those. For me, I've always used the default ones personally. I think the default ones work. Especially when you're looking at daily, weekly, hourly charts, 4-hour charts. I mean, most of these now, look, we've got the German chart here, which is the same default. US dollar, that's, Euro dollar daily chart. We've got a 15-minute chart here, and the MACD is exactly the same here, like 12, 26, and 9. But look at the fantastic bullish divergence it's showing you on this sterling dollar. So sterling dollar, the market's been coming down, but the MACD's been going up. There's your crossover point. You buy the sterling dollar at this crossover point here. bang, the rest is history. There we go. Take your profit
Now,
where you
Gopal,
want to.
we've just had two questions back to back, which are asking the same thing essentially. So at which point do you decide overbought, undersold? And David also asks, how do you know where to set overbought and oversold settings? Now with that,
Well,
Gopal mentioned with the RSI, there are particular tram levels. Now with this, Gopal, perhaps if you were to switch back to one of those charts, I believe you've just looked at essentially support and resistance.
Yeah, I could show it on this one if you look at it. I mean, this is only a 15-minute chart, but let me
There's no specific science to it as to you should put it at the 70, you should put it at the 30. That's not the case here with the MACD. You are just looking at those highs and lows of the MACD line itself.
Yeah, you can generally see, if you look across, you can generally see areas of where the market was overbought and oversold here. So let me just cross that back over. And also here, look, you've got an area of support here, massive area of support there, look. So you've got support and resistance here, look. Now, this area here was obviously oversold. It's touched it here and twice here. So we've got an oversold area here. We know this is the market has been oversold here. If we look back in time, if we just make the chart as small as possible, you can see where the MACD has printed extreme levels here. So we've got on the 4th of November, it got oversold. Today, I think that's today and the 11th, sorry, no, last week. And this is on the 12th. And this was on Friday, I think, or 13th, around there. Yeah, it's oversold again. So this area around here, you know, it's approximately an oversold area. So you know, potentially, if we look at the MACD, it's been increasing. The market's been going down. We know the area is rife. We've got support here. You can see here. Look at that area of support. There's resistance. There's support. Look how many times that price has been supported. So you know when that price does cross over is the time to buy. So if we did buy anywhere here, when any of these histogram bars here, anywhere here, just after that, you'd have been making some really nice money on that trade. That's only a 15-minute chart, but it shows you. It just shows you there. I wouldn't go any lower than 15 minutes, Darryl. I would not go any lower than 15 minutes, guys. I know some of you like to look at, 5 minutes and all this. For me, it serves no purpose. It's just far too much volatility, far too much noise. The markets, you're not going to get the benefit out of it. I've never used it. I mean, let me know. Does it work with a 5-minute chart? For me, I wouldn't really want to try it. I like to use it with a daily, hourly, maybe a 15-minute on day trading.
The divergence aspect of it would certainly be more useful because, again, the actual crossover part is the lagging aspect of this indicator, and the smaller the time frame, the more it's got the potential to lag there. Now, what I just wanted to do... The crossover is the lag.
Yeah, it's the divergence that's giving you the leading light on what's happening in the market, remember. So the crossover is your point of entry. It's going to be lagging, but it's the actual divergence it's showing you that's going to give you the heads up to knowing when to enter or not. So just bear that in mind.
So I just want to highlight here is again that Gopal, you drew in this very nice line of support here. Now, again, I love it when we actually link back to previous webinars, previous things that we've looked at in these sessions, because that's what these are all about, to learn and then to apply that onto your own trading. That's just an additional confirmation of that, which is very, very nice. Now, I did see a question which I just want to address here very quickly. I mentioned earlier, of course, about the histogram, that third component of the MACD, how some individuals, myself included, I don't tend to actually look at that. I look at the actual crossover of the MACD and the signal line. They are essentially telling you the same thing. It's just that you can either look at the lines or the histogram. So if you want to change that, with a lot of brokers, they'll give you the option here on the right-hand side. At the moment, it says show both. But I could have it so that I look exclusively just at the lines, or I could have it so that I look exclusively at the histogram. Now, the only problem with looking at the histogram exclusively is that, yes, I can identify the crossover point, but I'm not able to get that same kind of divergence which Gerpel was going through. Hence why I personally try to make it as simple as possible by just looking at the actual lines themselves. But again, the default always has it so that you're looking at both of those. But I just thought I'll answer that question very quickly.
I don't generally look at the histograms, but you can use the histograms in a way. I don't massively use it, but again, histograms are just another aesthetic way of looking at the actual MACD and signal lines. I think more prominent are the actual lines themselves. You can see here, look, rather than using the MACD lines, you could probably use the histogram to show overbought and oversold areas. So if I move this here, you can potentially, it's the same result, but I'm using the tip of the histogram. You see that? It's showing exactly the same thing, overbought and oversold, but rather than actually using the lines, I'm using the histogram itself. So you'd use same here on the oversold part here, look, overbought side. So let's just say roughly around about there. That's where you know when the market's roughly overbought. So it's just giving you a bit of a heads up. And again, this is a 15-minute chart, remember, so it's a lot more shifting quicker. Was there any questions or any sort of you wanted to launch, Jonathan?
Yeah, there was just another question which I just saw. So just to kind of reiterate again, as I saw another question, these tram lines, again, there is no particular science for that. It's just based on kind of where the highs and lows have been for the MACD line, and so that way you can actually identify those extreme areas. That's where Gerpel's then drawn those lines. Now, I know we are fast approaching the end of the session here, Gerpel, but there are just a few questions that I want to just ask the audience very quickly. So, of course, Gerpel and myself, 2A Markets, we help individuals with regards to their trading. So whether that's their broker platform or specifically the kind of the indicators which an individual is looking at on their broker platform, hence the sessions today. Now, if I just load up a question here, we do like to get a gauge of who's actually trading when they attend these events. So if you could just answer yes or no there, that would be absolutely fantastic. Again, if you do need any assistance with regards to your trading, if you are one of those individuals that are putting in no, then get in touch, drop us a message. We'll be more than happy to go through that with you. That is what we're here for. Ultimately, there are lots of different brokers out there, and it's important to find out whether or not you're using the right broker for the strategy which you're looking at. So whether you're looking at, for example, just stocks, or whether you're just looking at very short time frame trading or longer time frame trading, there are different brokers which suit. And perhaps what we ought to do at some point is a topic which looks exclusively at the different brokers. But again, we are here to help, so do let us know. In fact, interesting results here, Gerpel. So 68% of people said yes. I would have actually thought more people would have said yes there, Gerpel, in fact. So that means 32% of people have said no there, which is interesting. And again, my message to those 32%, if you need any help, that is what we're here for. I do have another poll which I just want to launch quickly before we end today's session. Again, MACD, this week's topic, it was chosen by everyone at home today, so we do like to launch a poll here. So what topic would you like us to cover in a future session? So if you're able just to pick which of those topics. We've got the Bollinger Bands, parabolic SAR, trading volume, trading sentiment, and risk management. It would just be interesting just to get a gauge of what individuals would like to see in next week's session here.
Yeah. There's still quite a few to go through, isn't there?
Oh yeah. We've got many topics, and we really do appreciate, of course, the suggestions. If you have any suggestions, just let us know in the chat here as well, or just respond to one of those emails. We're keen to kind of direct this, for you to dictate what we go through in these sessions. It's about you getting the most out of these.
Really enjoyed today, Chris says, giving me more confidence about two-way markets. I should hope so, God blimey. I was going to say, no, you listen, guys. These sessions are they're here to basically to give you our experience. I've been working in these markets now for almost 18 years. You know, there's plenty of pitfalls there. There's plenty of things you can use to your advantage to make your trading a lot more successful, a lot more consistent. Now, the mistakes I see every day with retail clients and what they do, they're pretty much the same mistakes. So if we can help people to clear and how to use these sort of technical indicators a bit more clearer and a bit more useful, you know, from our point of view, we've done our job. So hopefully you do find them useful. You know, we appreciate the kind feedback. You know, it gives us, you know, more sort of motivation to give you more topics, and of course to make sure that we can help you in any other respect as well.
And I'll just bring up our contact information at the end so that you'll know exactly where to get hold of us. However, just a few final questions here. I know we are short of time, I'm sorry, but let's have a look here. They're moving quite quickly. So somebody has asked about trading psychology. With regards to trading psychology, that is actually one of the topics that we have gone through. I think that was our very first session, Paul. And somebody else has also asked about whether this session would be recorded. And so the answer to that is yes. And so for individuals that want to watch any recordings, just go to twowaymarkets.com. Let me just bring up our contact information here. So it's twowaymarkets.com, and there's a section on the website called webinars. Just have a look at that, and you'll find all the previous sessions there. So there we are. Perfect.
Lovely. Well, thank you very much, everyone, for attending. And, you know, hopefully, again, we've had some good news again today from another pharmaceutical company, and hopefully the battle against this dreadful disease is at least there could be a turning point here, Jonathan. So, you know, we've had a treacherous 2020, and hopefully things will get better as we're closing in on Christmas. So we look forward to speaking to you next week, and enjoy and safe trading, everybody.
Thank you very much, everyone. Cheers. Bye for now.
Bye.